Excellent. Very good. So I want to thank everybody for coming here today. I'm going to quickly just do a little introduction about our group here. Hopefully everybody can see my screen here. So this is the Multifamily Investing Group, Passive Investor Group. James is actually out of the country, so he's not going to be joining us tonight. I'm Trevor, as many of you know. The format's the third Thursday of every month, starts at 7:30. We usually do the chat so you can tell people about it. We have a 20 to 35-minute presentation with Q&A, and then we'll do a breakout session. Always feel free to invite anyone who's interested. And if they can't come, we do send them a recording. And disclaimer, we're not presenting anything. This is for educational purposes. There are no offerings or anything being offered at this particular event. And today we're going to be talking about using your self-directed IRAs. So I'm going to stop sharing. And Zach, I'm going to just let you introduce yourself and then go ahead and start right into your presentation. I've seen Jack's presentation a couple of times, and it was by far, I've seen a lot of self-directed presentations, by the way, and Zach, yours is the best one. So I reached back out and said, would you please go ahead and do an thing for us tonight? And so you should be able to share your screen. I'm going to let you do your presentation. I know you're not feeling so good, so just get through it. We'll get some questions and we'll call it a night.
That works perfect.
And everyone can put their info in the chat if you'd like.
All right, let's see here. All right, can you guys see my screen?
Yes, sir.
Perfect. Let me just go 1 second. All right, so like Trevor said, Trevor, first of all, thank you for having me out. I really appreciate the kind words. We try to really spread as much as we can about spread as much information as we can about these self-directed IRAs. Just not many people really know that you can use them, especially when it comes to real estate investing, right? Most of us have our retirement accounts, but we kind of just put the money away. It's managed by someone, and we hope and pray that it grows and that the market is kind to us, really, right? Not too many people realize how active you can be, especially when it comes to the type of investments that you can make within your IRA. And like Trevor said, bear with me a little bit. I'm going to be stopping to get some water. I'll maybe be coughing a little bit. I'm just getting over COVID. So we're going to power through this one. All right, guys. So today I wanted to kind of talk to you about how to go about utilizing the self-directed IRA, really introducing to you what the idea of a self-directed IRA is, and then taking a little bit of a deeper dive into what it can look like when it comes to multifamily syndication investing within a self-directed IRA. All right. So the first thing is obviously we got to get it out the way. Everything you're about to see here is for your educational purposes only. All right. At Quest, it's important to understand the role that we play when it comes to your retirement investments. We're here to really offer as many resources and as much education as we can when it comes to our clients and investors. We're also here to really facilitate just about any type of transaction you'd be looking to make within your IRA. But that being said, Quest does not offer any sort of tax, legal, or investment advice, nor do we endorse any specific investment. All right, so for those of you who don't know us, we are Quest Trust Company. We're the largest self-directed IRA custodian in the state of Texas. We have roughly 20,000 active investor clients all across the country. We have 2.7 billion in assets under administration. We have over 100 employees, 34 of which are certified IRA service professionals. All right, we really like to brag about this one because the growth that we've experienced has been very organic, right? We've had the opportunity to acquire smaller self-directed IRA custodians. That's the route that some of the larger custodians have taken. But the thing that kind of separates us is that when you call us, you've got someone to answer the phone, right? You're always going to get an employee who answers the phone. And if you want to take a deep dive, we've got 34 IRA service professionals there to take that dive with you. And as it stands right now, the latest numbers we're showing, we have just over 450 million in undirected cash sitting in our clients' accounts. What that represents is opportunity, right? Whether you're a part of that Quest pool or you're someone looking to raise capital to make your deal happen, that's where the opportunity lies. So a little bit about me. Originally, I'm from New Orleans, Louisiana. I started off as a chemical engineer at LSU. before deciding it's not really what I wanted to do. So I took a couple years off and really just focused on me, figured out what direction I wanted my life to go in. From there, that's when I landed on finance. So sold everything I had. I moved over to Houston, and I finished up my degree in finance at U of H. All right, not too long after, I found Quest, and to be honest with you, Quest was going to be a stepping stone. It wasn't going. I didn't know anything about self-directed IRAs. I didn't know what a custodian did. I really didn't know much about the industry at all. But it really didn't take long for me to buy in just because of how well the company treated its employees. It was something that was really cool to watch, even through a pandemic. They were supporting their employees even when the company was hurting. So a little bit about my career at Quest. I spent 4 of those years. I've been with Quest for 4 years. 3 of those years were with our auditing team. All right. So what that meant is that I oversaw every single investment that came through Quest. Me and my team, we audited everything to be sure everything was in compliance, everything's vested correctly. We really got to know the nitty gritty details of how these investments were structured. Right. So it gave me a really good understanding of the structure of those investments. And now I get to be on the IRA specialist team. So I'm nearing a full year with the IRA specialist team. So now I'm seeing the front end, right? I'm seeing the conversations between syndicator and investor, between lender and borrower, right? I'm seeing how these deals happen. So it's given me a really wide angle lens of an overall picture of what these deals look like. So I'm eternally thankful to Quest and to people like Trevor who give me the opportunity to now come out and speak and share what I've learned with you guys. Because I really think this can be incredibly useful. And I as I learn more, the more and more important I think it is that we get the word out about this. So before we dive into the nitty gritty, it's important to understand how the IRS views just about every single entity when it comes to entities within the US. All right, they're going to fall into two categories. The first one is going to be your taxable entities. And obviously, if that's the first one, then the second one's going to be your non-taxable entities. All right. So first on the list when it comes to those taxable entities is going to be you, right? Anything you would establish, which makes sense. You go to work, you earn W-2 income, 1099, Schedule C, whatever it is, you're taxed on that income as you make it, right? Now you start making some investments and maybe you want some asset protection. So you decide to establish an LLC. Well, that LLC is also going to be considered a taxable entity, right? Or maybe it's a disregarded entity, depending on how you set it up. And a step further, you establish a business, you're selling products. Now you set up an S Corp or a C Corp. Well, those are going to be taxable entities as well, either as the entity itself or passing through as the owner. It even extends to things like trusts, right? Whether that's a land trust or a personal property trust, those are all going to be considered taxable entities. Now, when I say a non-taxable entity, usually the first thing that comes to mind, it's a charity, a nonprofit organization, right? A church. Well, your self-directed IRA is going to be considered a non-taxable entity, right? This also extends to things like your qualified retirement plans. So your 401ks, your 403bs, TSPs, right? Those are all going to be considered non-taxable entities. And this even groups in things like the solo 401k that can be self-directed just like an IRA, right? But what is self-direction? Really, what does that even mean, right? Well, guys, it really is just a marketing term. If you look at the IRS code, there's no mention of the term self-directed at all. That is just there to illustrate you're the one in control, right? You are in the driver's seat when it comes to the investments made within the IRA. There's no legal distinction between your self-directed IRA here at Quest versus your IRA at another custodian like Fidelity or Charles Schwab, TD Ameritrade. Right? The only difference is what you're allowed to invest in. They allow you to put your funds into public assets. We allow you to take those funds and put them into privately held assets, specifically real estate style investments is what we specialize in. All right. So now that we know self-direction is really just a marketing term, what types of accounts can we self-direct? Well, at Quest, we hold 7 different types of accounts that fall into 3 different categories. The first one is going to be our personal accounts. Excuse me, let me take a drink real quick. So these personal accounts are going to be those accounts that everyone's heard of, right? This is that traditional and that Roth IRA. Right? By far the most common at Quest and the most common in the United States is going to be the traditional IRA. Now, it's not to say because it's better than the Roth IRA. I don't think that's the way to think about it, right? Neither one is better than the other. They each play their own individual role. But the reason the traditional IRA is so much more popular is because of its pre tax status. All right. So when you have funds sitting in an old 401k, right? You decided, all right, I've now left the company or I've retired, whatever it is, I should now no longer work for that company. I don't want to roll those funds over into an IRA. Well, unless you've specified otherwise, you and your employer have been putting pre-tax funds within that account, right? They put pre-tax contributions within that account. So when you roll them over, most people are obviously looking for no sort of tax implication. So you want to roll them over into an account that matches that pre-tax status. That's going to be where the traditional IRA comes into play. Now, once the funds are in there, it's working pretty close just how it worked in that 401k, except now you're driving, right? So you're making the investments are growing tax deferred, and then come to retirement age, you're going to take the funds out, and whatever amount you're taking out is just going to get added to your income in the year in which you take them out. Now, on the flip side, it's going to be the Roth IRA. Personally, my favorite account, right? Whereas the traditional IRA was pre-tax, the Roth IRA is a post-tax account. This gives it two distinct advantages. The first one is that any contributions made to a Roth IRA are going to be able to be taken out at any time, tax and penalty free. Right? This is one of the few accounts that allows you to take those funds out whenever you'd like because they're already post tax. Uncle Sam has already gotten its slice of the pie. It no longer cares what you do with that money. Right? So let's say over the next 5 years, you maximize your contributions, right? 6,000 a year. Now you've got 30,000. Well, at the end of year 5, you decide, man, I want to buy a car, right? I want to buy a car, but I really do not want a car note. I don't want a car note at all. Well, now you've got a $30,000 pool of funds to pull from, right? To go towards whatever you'd like. Right. The second distinct advantage is that because these funds are growing in a post-tax account, as long as when you take them out, right? Any of the growth experienced within that account, as long as when you take them out, you have A, had a Roth account open and funded for 5 years, and B, our retirement age, so over the age of 59 and a half, that means all of that money, 100%, no matter how much it has grown, is going to also come out tax and penalty free. Right? That means if you took that 30,000, kept adding to it, right? Kept contributing, kept growing it, turned into 50, 100, 500,000, you have all of that money to pull out tax and penalty free. Uncle Sam doesn't get to touch a dime of it. Right? That's really what makes that Roth account so powerful. I'm not going to spend too much time on the next category, which is going to be our employer accounts, right? Just know that these accounts are for self-employed individuals who are looking to take advantage of the higher contribution limits that come along with these accounts. All right. This category is going to include the SEP IRA, the Simple IRA, and the Solo 401k. Each of them serving their own purpose, but always going to be geared towards self-employed individuals who have smaller firms, right? Doctors and dentists utilize these a lot. And finally, the last category is going to be our specialty plans, right? This is going to be the Coverdell ESA and the HSA. Now, these are the only accounts on here that are designed to benefit you now, right? These are not retirement accounts, but they can be self-directed and partnered with all of your retirement accounts here at Quest, right? So the Coverdell ESA is just meant to go towards education expenses, right? So to alleviate some of the stresses that come along with education, right? This is kind of the counter to the 529 plan that is state specific. The ESA can be used anywhere, right? It's not state specific. Now, how it works is you're putting post-tax funds in there. You can, again, partner and self-direct to help it grow a little bit faster. And then you can take those funds out tax and penalty free as long as they're going towards qualified education expenses, right? Things like books, tuition, uniforms, stuff like that. And also there's the HSA. The Health Savings Plan is one of the most underutilized but powerful accounts that there are. All right. This is because it's what's known as the best of both worlds. It has the tax deductible contributions of the traditional IRA, and the tax and penalty free distributions of the Roth IRA, right? That means you put funds in, you grow it, as long as when you're taking them out, they're going towards qualified medical expenses, they're coming out tax and penalty free. Now, excuse me. Now, I know what you're thinking, right? That list is probably very tiny. What's going to qualify? Well, there's actually one of the few cases where the list of what you can't spend it on is shorter than the list of what you can spend it on. I'm talking about over-the-counter drugs, prescription drugs, co-pays, dental, vision, really just about anything you would need when it comes to your medical needs, you're going to be able to use with an HSA. And a cool story I've seen is that they'll kind of accrue their medical bills over the years. And as long as all those medical bills were accrued after you set up the HSA, you can cash them in one big distribution at the end, pay for something you're wanting. Our president uses HSA to pay for a plane. He's a pilot, a little two-seater plane. Yeah, it's one of his biggest purchases. Just a fun little story about how you can utilize an account like an HSA. So now that we know what types of accounts you can self-direct, why should you self-direct an account at all, right? Well, there are several benefits, but the three main benefits that we'd like to focus on are going to be diversification, right? Tax savings, and investing in what you know best. So let's take a look at what each of those means. The first one, diversification. Whenever you talk to a financial advisor, right, he's going to say, let's diversify your portfolio. Right, let's get you into some steady mutual funds that are low risk, low yield. Maybe let's put you in a little bit of risky, a little, smaller portion of your account. Let's put in some risky, maybe high yield stocks, and then maybe let's buy some bonds, right? Well, if you're in the public sphere, you're kind of just putting your eggs in different parts of what is overall the same basket, right? What a self-directed IRA at a custodian like Quest allows is for that true diversification, right? You're getting out of the public market, right? You're going into privately held assets that have their own market that you can understand, right? Secondly, it's going to be the tax savings. Now, whenever you're making an investment, right? Let's specifically talk about real estate. So if I were to do a fix and flip personally, right? I purchase the property, I fix it, flip it, I sell it for profit. Whatever profit I make, I really have two choices, right? I'm either A, going to pay the taxes on it and get to keep what's left, or B, I'm going to try to put it in a 1031 and to try to defer those taxes until later, right? But when I take that route, there's restrictions that are going to be put on that money, mainly the timeline under which I have to find my next investment, the type of investment it has to be, and even the value of the investment that it has to go towards, right? But with a self-directed IRA, it negates the need for the 1031 at all. All of the funds are coming back either tax deferred, or in cases like the Roth IRA or maybe even the HSA, they're growing tax free, right? It's coming back tax free completely. So there's no need to try and put into a 1031. They come back to you, you get the full profit, and now it's up to you what you do next. Whether you want to hold on to it, look for a next investment within the real estate space, or put into a brokerage IRA, let someone manage it, right? It's up to you what you do with it. And finally, investing in what you know best. Every one of you is here because either A, you have some sort of foundation in real estate investing, or B, you're looking to build that foundation. Right? So why not utilize that foundation to help grow your retirement account? Right? This is the most important account there is. We can really talk about all the types of different accounts and how you should really spread out your money, right? But at the end of the day, that retirement account is supposed to be there to dictate your quality of life come retirement age. So why wouldn't you want to utilize the information and knowledge that you have to help grow that as much as you can and not leave it to the whims of a market that you kind of just have to cross your fingers with, right? So the IRS is not going to give you all these benefits though, without putting some restrictions, right? So let's take a look at what those restrictions look like. They're going to fall into three categories. First one is going to be the people restrictions. Second one is going to be the transaction restrictions. And then third one is going to be the investment restrictions. right? Thankfully, the IRS has broken this down to a very easy to read and not at all confusing graph, right? It's the IRS. Nothing ever is going to be that straightforward, right? But thankfully at Quest, we've broken this down to a very palatable form. How you can understand what you can and can't do with your IRA. Give me 1 second. So let's take a look at people restrictions, right? When it comes to disqualified parties to your IRA, believe it or not, the very top of the list is you yourself, right? It seems weird, but really think about it. These are accounts that are supposed to benefit you come retirement. If they allowed you to take a benefit now, that's what everyone would do, right? We would all just simply use these tax advantaged accounts to grow our wealth today. Why wouldn't you, right? So what they do is they make sure that you're never crossing that white line, right, between you and your IRA, that you're never on opposite sides of a transaction, right, from your IRA ever. So on the list of disqualified parties, it's going to be you, your spouse, your lineal ascendants, so parents and grandparents, your lineal descendants, children and grandchildren, their spouses, or any companies that those people own, control, manage, or are highly compensated by. Really, anytime they're affiliated with a company, right? This just means that you can't be on opposite sides of the transaction, but you can partner with those, right? And we can get into that a little bit. It gets gray, it gets a little hairy, but there are ways to partner with your IRA, and there's a proper way to do it. So now that we know who we can't commingle funds with, what can't we do with them? Well, we cannot buy, sell, trade, loan, extend a service to, or receive a benefit from the IRA, whether direct or indirect, right? Which makes sense. Again, never crossing that white line. So we're never buying from our IRA, we're never selling to our IRA, right? Well, I'm never loaning to or from my IRA. Now, extending a service to, what does that mean? Right? Believe it or not, that's the extent that the IRS explains it. They do this on purpose. But practically, what does this look like? That means if my IRA owns a property, I cannot personally go out and do all the repairs on the property, right? Because, 1 second, what I've just done is saved my IRA money, right? So my IRA has received a benefit from me personally. We cannot allow this. And finally is going to be the investment restrictions. So I didn't even make a slide for this because it's really simple. Now, the IRA, all it can't invest in is going to be life insurance policies and collectibles. Right? Things like vintage cars, art, stuff that it's hard to get a really good appraisal on because it's much more subjective. But that's what we can't do. What can we do, right, within a self-directed IRA? As you can really do just about anything you'd want to do personally, right? If you wanted to get into real estate, that is by far the most common strategy that we see, right? But this takes many forms. Do you want to get into direct ownership, right? Do you want to start buying fix and flips? Do you want to start doing buy and holds, right? You want to do rental properties, all be done within an IRA. Let's say you've got some money, but you want to lend it out. You know people who have deals. You don't know the deals yourself, but you know people and you trust them. And by all means, be a lender, right? Be the bank. You're the one who you're in full control, right? You can negotiate interest rates, maturity dates. You can set terms that you're comfortable with. And finally, private entity investments. These are going to be things like startup companies, joint ventures, syndications, right? By far, the most common investment that we have at Quest is going to be multifamily syndications. There's a reason, because of its passive nature, right? You get to make your investment, you sit back, you wait 3 to 7 years, 3, 5, 7 years, and you get your return. So once I have this self-directed IRA set up, how do I fund it? Well, there's 3 ways to fund it. First one's going to be your direct contributions. How much you're able to contribute to each account is going to be dependent upon the type of account that you set up, right? But this is just simply taking money from your personal checking or savings account and putting it towards your IRA, either as a tax deductible contributions in cases like a traditional IRA, or a non-tax deductible contribution like a Roth IRA. Finally, or I'm sorry, secondly, is going to be transferring it from another IRA. If you've got a rollover IRA at a place like Fidelity or Charles Schwab, right, you can transfer that directly over to a self-directed IRA at Quest, right? Because it's going from trustee to trustee, it's something that's not even reported to the IRS. This is just like moving funds from a checking account at Chase to a checking account at Capital One, right? The IRS doesn't even require that you let them know. And finally, is going to be rolling it over from an old employer plan. Now, the reason I have old underlined there is because usually the best time to do it is going to be once you have a separation of service, right? Just because that's going to be the easiest way. Once you're no longer working for that employer, you can either roll it over to your next 401k or roll it over to an IRA, whether at a public custodian or a private custodian like Quest. Now, can you roll over funds from an existing 401k that you with a company that you're actively working with? Potentially, all right. But there's going to be some requirements. You're going to ask if they allow for what's called in-service withdrawals, right? And even if they do, you got to ask when they allow them. Some will allow it out the gate. Some won't allow it until you're fully vested. Some won't allow it till retirement age. So it really will depend from plan to plan, which is why I say it's always easier just to move it when you have that separation of service. But how's the investment process work? Well, at Quest, it's pretty easy. You simply let us know, right? And obviously, this is assuming you've got the account set up, you've got the funds in. Call us and let us know that you're ready to make an investment with your IRA. From there, we're going to assign a processor to you. It's going to specialize in whatever type of investment you're looking to make, right? Whether that be a real estate investment, a promissory note investment, or a private entity investment. That processor is going to work with you, as well as with any title company, borrower, syndicator, whatever it is, to help gather up all the documentation. We'll audit everything to be sure everything's in compliance, and everything's vested correctly in the name of the IRA. From there, once we've got it all good to go, everything's signed, we can fund that investment in 24 to 48 hours. All right, we work quickly because we know opportunities in the real estate space have very limited, tight timelines that we as a custodian have to hit in order for you to make your investments happen. Now, one type of investment I want to look at particular is going to be syndication investing within an IRA. How does it work when it comes to cost segregation, forced depreciation? What is UBIT and UDFI? And how can we make sure we're utilizing the K1s that we receive? So, me, if I'm making a syndication investment personally, right? Let's say it's a very by the books, plain Jane syndication. I make my investment every year. If I'm a full-time real estate investor, right, I'm going to receive that K1 and I'm going to get to see that negative depreciation, or I'm sorry, that forced depreciation on there. And I'm going to get to claim it against my taxable income for the year. Again, this is assuming I'm a full-time real estate investor. Right, I can do that for the first 3 years. Then I'm seeing fourth year, maybe we break even or it's a negligible amount either way. And then fifth year, I receive my profit. From there, I'm paying taxes on that profit. Right now, doing this in an IRA. So, because the IRA is a tax exempt entity, it does not have any taxable income. However, with the way that syndications are structured, it can run into something called UDFI, right? That's unrelated debt financed income, which is a subsection of UBIT. Okay, so let's look at this in the form of an IRA. IRA makes the same investment, right? But that syndication, right, more than likely is roughly 70% debt leverage from an institution, and then the additional 30% is people like me using our funds to invest, right? Because of that, the IRA, the first 3 years will receive its K1s, but it does not have taxable income and therefore cannot claim the K1 against anything. That's okay. Hold on to the K1. All right, we're going to put that in our back pocket and save it for later. First 3 years, I get that K1. Let's say it's, I don't know, 12,000 forced depreciation for the first 3 years. Fourth year, break even. Fifth year, we get our return. Now, let's say in the case of the IRA, I make $50,000 profit, right? Now, because the syndication was 70% debt leveraged, the IRS says, wait, hold on. You have a tax exempt entity, right, that is now utilizing someone else's institutional funds to make a profit. And they say, no, we can't have this, right? Because of that, you're going to be forced to pay a UDFI tax, right? Now, how that tax works is that the proportion of my income, right, is going to be equal, or I'm sorry, the portion of my income that is subject to UDFI is equal to the proportion of the project that was debt leveraged. So that's syndication, 70% debt leveraged. It means 70% of my income is going to be subject to UDFI. So in this case, I made $50,000. 35,000 of it is subject to UDFI. But now the IRA has taxable income. Because it has taxable income, I get to now use those K1s that I got in the first 3 years to go against that taxable income. Right? So in the case, like I said, 12,000 a year, that means I've got $36,000 total in depreciation against a $35,000 taxable income. Boom, I've just canceled out my tax burden on this investment. Right? So UDFI kind of spooks a lot of people, but I'd say about 85% of the people that make this investment within their IRA see little to no taxation at all, right? Which is why it's such a popular investment, right? If this UDFI was really taking such a hit, it wouldn't be the most popular investment we have at Quest. All right, so that's how you go about utilizing those K1s within an IRA that normally is a tax exempt entity with no taxable income when it comes to a syndication investment. All right, I know that was kind of a lot. It's a pretty complex topic to kind of just squeeze into one slide. But I'm happy to answer any questions. That's the end for me. That's all my contact information. Trevor, thank you again for having me. If you guys have any questions, let me know.
It's my pleasure. I think I got to ask everybody to unmute because I muted them all. Charles, did that answer your question?
Oh, here, let me go ahead and stop sharing my screen.
I can't.
I think you can talk now, Charles.
Yeah, well, pretty much. The only question I would have is that as you make those depreciations, your capital account is decreasing. And the actual gain is from the capital account of the last year to what you take in. So the 50,000 you're talking about, I put in 100, I get 36, I think you said, then my capital gain is actually going to be the 50 plus the 36 and then minus the 36. So I don't.
So like I'm putting in 100, right? I'm making, let's say 50 back, right?
Yeah, you're going to get 150 back total.
Yeah, exactly.
But the capital gain at the end of the deal is 36 of depreciation plus the 50.
So within an IRA, now you may be asking a question that's above mine, that might be my head, right? So within the IRA, because all it's seeing is 50,000 come back in profit, right? It doesn't have to delve into anything besides that. So because it just simply has 50,000 of income.
So the basis doesn't come into play.
No.
Okay.
When it comes to
that is not what happens to a person who does it. Now the IRA, I don't know. It's just, you may be right.
Right. And so when the basis, I can see what you mean. So the basis comes into play things like when it comes to an IRA going from a traditional to a Roth, right? So let's say I have 50,000, let's say just to make it simple, let's say I make a contribution, right? I'm doing a backdoor Roth conversion. So I make a non-tax deductible contribution, right? $6,000 to my traditional IRA. Fill out an 8606. I want to say, hey, this is a post-tax contribution to this pre-tax account, right? I don't then get to do a Roth conversion and say, hey, I just want to use this 6,000 to convert, so there's no there's no tax burden on that Roth conversion. Right now, my basis is going to come into play.
Okay.
That makes sense because that's a tax that I'm paying.
Yeah.
When it comes to the IRA is paying this UDFI tax, not me as an individual. So my
Okay,
basis won't have anything to do with it.
I have, it may be special for an IRA. I'm just familiar with when I put in 100
Mhm.
and they take that depreciation, it actually come, or they pay me the depreciation, whatever, any distributions all cause the capital account to decrease, and that shows up on the K1. So at the end of the deal, the last year, the gain that I have to pay taxes on is the difference between the capital account and what I haul in. In this case, it would be whatever the depreciation is, which is sort of why if you're not selling a deal this year, then all that hoopla about bonus depreciation is minimal at most, because all you do is
Yeah.
hold it until the end for the people that are like me, full-time investors, but not real estate professionals.
Yeah.
But you know, that may be special for an IRA. Don't
Yeah,
know.
because keep in mind that IRA isn't paying any sort of capital gains tax at all.
Well,
Right. The IRA is it's a tax exempt entity. So it isn't subject to any sort
well,
of
the
capital gains.
UDFI is paying the gain, is paying it on the gain. That is what the UDFI is on.
Well, yeah, but it's not paying what you would consider your capital gains tax, right? It's paying a specific UBIT tax.
Okay.
You know what I'm saying? So like so whenever you're making your return, capital gains, whether it's either short term, right, or long term capital gains, right?
Yes.
Right. Now the IRA, it doesn't matter. It doesn't matter whether that was a short term deal, long term deal, right? Solo 401k, it gets a little bit stickier, right? But when we're talking about an IRA, if I did the same deal, let's say my IRA purchased a property, right? $100,000 property. I put 30,000 down, $70,000 loan. All right.
Sure.
Again, let's say I put in towards a deal, I make a profit of 50,000 just for ease of numbers. Same thing. I'm still having that same exact tax burden as my deal with the syndication.
Okay. Tax is always a very interesting and confusing topic.
That it is.
Yeah. Awesome. Anyone else have any questions? You can feel free to unmute yourself. Otherwise, we're gonna let Zach go back to bed, and we can just do a little bit of networking. We lost a couple of people here, so hopefully they didn't fall asleep. But it was excellent, Zach. Thank you so
I
much.
hope not.
A little plug for Quest. I funded in a day a deal with them this week, and it was very good. So quite happy. So little plug for them. That I'm a customer as well.
Absolutely.
Zach,
We appreciate
as
it.
my 2 cents, you might want to try the infusion stuff they talked about. And I don't know